All right, today we are diving headfirst into one of the most powerful and, frankly, most misunderstood tools in all of finance: options trading. This is the wild world of incredible leverage, super complex strategies, and yes, very, very significant risk. It's a place that promises massive rewards, but, you guessed it, hides equally massive pitfalls. So, let's get this figured out.
So let me ask you a question, because this really gets to the heart of why options are so tempting. Let's say you're really optimistic about a stock like SoFi. If you wanted to buy 100 shares right now, you'd be shelling out nearly $3,000. That's a big chunk of change. But what if I told you there was a way to control that exact same position with all its potential upside for less than $200?
And that, right there, is the magic trick of options. That's the incredible power of leverage that makes this whole scenario possible. But listen, this is not free money. Not even close. That power comes with a huge catch, and it's what makes options one of the most dangerous things you can touch if you don't know what you're doing. This two-sided coin, immense potential on one side, major risk on the other, is exactly what we're going to unpack.
Okay, so how is this even possible? How does that leverage actually work? Well, to get it, we have to start at square one. What exactly is an option? Because it's probably not what you think.
Okay, first things first, an option is not a stock, it's a contract. Think of it like a temporary agreement. And there are a few phrases in this definition that are absolutely crucial. The first one is the right, but not the obligation. That is the secret sauce right there. It means you have the choice to do something, but you're not locked in. You're not forced to. That flexibility is what you're paying for. Second, it's for a set price by a specific date. These are locked in stone. And finally, and this is super important, one standard options contract almost always represents 100 shares of the stock.
Now, every single option strategy, I don't care how complicated it gets, it all boils down to two basic flavors: calls and puts. They are the yin and the yang of the options universe. And understanding the difference between them, well, that's everything.
It really is this simple. You buy a call option when you're bullish, when you think a stock's price is going to shoot up. A call gives you the right to buy that stock at a locked-in price down the road. On the flip side, you buy a put option when you're bearish. You think the stock is headed for a nosedive. A put gives you the right to sell the stock at a locked-in price. So it's pretty easy to remember. Calls for up, puts for down.
You know, here's a really great way to lock this in your brain. A call is basically like a coupon. Imagine you have a coupon for your favorite gadget. If the price of that gadget suddenly skyrockets, your coupon lets you buy it at the old, cheaper price. Boom, instant profit. A put is totally different. Think of it like an insurance policy for your portfolio. You don't buy car insurance hoping to get in a crash, right? You buy it just in case to protect yourself. Same thing here. An investor might buy a put on a stock they already own. If that stock crashes, the put goes way up in value, which helps cancel out their other losses. It's a tool for protection.
All right, theory is great, but how do you actually do this? To trade options, you have to learn how to read the menu where they're all listed. This menu is called the options chain. And yeah, it can look pretty intimidating at first, but it's really just a big table of choices with its own special language.
Don't worry, before we dive into that, you only need to get 3 words down. Just 3. First is the strike price. That's the locked-in price we've been talking about. Second is the expiration date. This is the deadline. Your contract is literally useless the day after this date. And third is the premium. That's just the fancy word for the price you pay to buy the contract. Strike, expiration, and premium. Got it? Okay, let's see them in action.
Okay, here it is. This is a small slice of a real options chain for SoFi. Notice at the top, all of these options expire on the same day. Now look all the way to the left. You see that strike column? Those are all the different prices you can choose to lock in. For our example, let's just focus on the one that's highlighted, the $30 strike. Now slide your eyes across that row to the last price column. That's our premium, $1.89. That's the cost per share to buy this specific contract.
So let's do some quick math here. The premium is $1.89 per share, but remember, one contract controls 100 shares, so you just multiply that by 100. The total cost, the actual cash that will leave your account to buy this one contract, is $189. That's it. Not the almost $3,000 for the stock itself, just $189 to control it for a while. That's leverage in a nutshell.
Okay, let's put all the pieces together into a real strategy. We've got the theory, we know the lingo, and we can read the menu. So let's see how you would actually make a simple bullish bet on a stock using these exact tools. So the most basic bullish strategy there is just buying a call option. The setup is simple. The stock is currently trading for just under $30 a share, and you have this strong feeling, this conviction, that it's going to go much higher before that expiration date we saw. So you decide to make a move.
Here's how it plays out step by step. First, you select the option we've been looking at, that $30 strike call. Second, you pay the premium, that $189 for one contract. And third, you wait. Now, the goal isn't just for the stock to go up a little bit. It has to go up enough to cover the cost of your ticket. Your break-even point is the strike price plus the premium you paid. So $30 plus $1.89 means you need the stock to get above $31.89. Any price above that at expiration is pure profit.
So what happens next? Well, there are really two ways this can go. Scenario 1. You nailed it. The stock soars up to $35. Your right to buy it at $30 is now super valuable. In fact, that contract is now worth $500. You subtract the $189 you paid for it, and you've made a net profit of $311. But scenario 2. You were wrong. The stock just kind of fizzles out and never gets above $30. Your contract expires worthless, and you lose the entire $189 premium. Now here's the crucial thing. Your absolute maximum loss is defined. It's strictly limited to what you paid for the option in the first place.
And this right here, this slide shows you exactly why people get so excited about options. This is the raw power of leverage in a picture. Let's put these numbers side by side. If you had just bought the stock, that move up to $35 would have given you a nice, respectable 17.8% return. Not bad at all. But by using the option, your much smaller $189 investment turned into a $311 profit. That is a 164% return on the exact same stock move. It's like a magnifying glass for your money.
All right, now, before you get all fired up and log into your brokerage account, we have to have a very serious conversation. We've seen the incredible upside, and it is tempting. I get it, but trust me, understanding the risks is way more important for your survival in this game. This is the crucial warning. Do not skip this part. Let's just start with a cold, hard dose of reality. A huge majority of options contracts, we're talking somewhere around 75% of them, expire completely worthless. Just think about that for a second. For every 4 options that get bought, on average, 3 of them will die having lost 100% of their value. The buyer just loses their entire premium. This isn't some tiny footnote, it's the headline reality of playing this game. The odds are stacked against you from the start.
You see, there are these invisible forces working against you. The biggest one is called time decay. I want you to imagine your option is an ice cube sitting on the counter. Every single second that ticks by, a little bit of it melts away. That's time decay. Even if the stock price doesn't move a single penny, your option is still losing value every single day. As a buyer, you're not just betting on if a stock will move, but when. You're fighting the clock. And remember that awesome leverage? It's a vicious double-edged sword. It amplifies your gains, sure, but it also guarantees that a small wrong move can amplify your losses right to 100%. And that unlimited risk? That's for more advanced strategies where you sell options. If you sell a contract promising to deliver a stock at $30 and that stock rockets to $300, well, you are on the hook. There's no limit to how high a stock can go, and that means there's no limit to your potential loss. So this all brings us back to the big question, right? When you put it all on the scales, the incredible leverage on one side and the harsh realities of time decay and probability on the other, what are options really? Are they a sophisticated tool that lets you make a smart, calculated bet with defined risk? Or are they just a faster, more volatile way to gamble in the world's biggest casino? The answer, honestly, depends entirely on the knowledge, the discipline, and the respect for risk of the person using them.